what if they, being the United States government now, is scrambling to buy gold to replace what they've already loaned out or hypothecated or never had, those 261 million ounces of gold? That makes some sense to me. Because there's something else going on. It isn't a recession. It isn't a crashing dollar. It isn't a crashing economy. It isn't a crashing stock market. It isn't falling, plunging real interest rates. What is it? Why is gold where it is? You could explain some of it with inflation, but I think there's something else going on there, and I think what I've just mentioned could be a reason.
In an unprecedented turn of events in the precious metals market, gold prices have maintained around $3,000 per ounce, creating what industry veteran Michael Pento describes as a perplexing market scenario. Pento, the founder of Pento Portfolio Strategies, questions traditional market dynamics as gold continues its relentless ascent, despite various headwinds. The latest surge in gold prices reached a historic milestone when spot gold touched $2,946.85 per ounce, driven by a perfect storm of market conditions. U.S. President Donald Trump's recent tariff announcements triggered a flight to safety, while anticipation surrounding the Federal Reserve's January policy meeting minutes further fueled investor interest. A weakening U.S. dollar provided additional momentum, making gold more attractive to international buyers. According to Pento's observations from his 34-year career, the most intriguing aspect of the current gold market is its apparent immunity to traditional price suppressants. Whether interest rates climb, the dollar strengthens, or geopolitical tensions ease, gold's upward trajectory remains remarkably consistent. This departure from conventional market behavior has led to speculation about deeper underlying factors influencing the precious metal's performance. Historically, gold prices and the U.S. dollar have maintained an inverse relationship, with dollar strength typically acting as a natural brake on gold prices by increasing costs for international buyers. Conversely, dollar weakness has traditionally supported gold prices by improving affordability for foreign investors. However, this time-tested correlation appears to be weakening, adding another layer of complexity to the current market dynamics. Looking ahead, analytical forecasts paint an increasingly bullish picture for gold. Bullion Vault's AI-driven analysis projects gold prices to exceed $3,000 per troy ounce by the close of 2025. More optimistic forecasts suggest the precious metal could reach $3,265 in 2025, escalate to $3,805 in 2026, and potentially achieve $5,155 by 2030. Before we begin, subscribe to our channel and click the bell icon to stay updated with our latest content, market insights, and expert analysis. Stay informed and never miss an update.
There's a lot of reasons why gold should not be at record highs. We keep bouncing our nose against $3,000 an ounce. And you think about it, well, we're talking about interest rates. Well, interest rates, nominally speaking, have stopped going down. They're now headed higher. The dollar has been extremely strong. Bitcoin, there's an obsessive compulsive nature in the media and even in the administration about Bitcoin. I don't understand it, but that's stealing a lot of gold's thunder. Peace is supposedly breaking out all over the world, right? Ukraine, Russia, Gaza. Well, thank God for that. I hope it's true. You have the Doge boys, or actually it's just now one, in DC supposedly cutting out waste and fraud and abuse. So that's also very positive for our fiscal agenda going forward. So that should be negative to gold. So it just bothers me a lot that gold just can't go down. Have you noticed lately that the dollar goes up, gold goes up, interest rates go up, gold goes up, no matter what happens? Peace breaks out in the Middle East and in Russia and Ukraine, and gold goes up. Well, why is that? And I have a theory. I don't know if it's really, I have a theory that something's going on. And I've heard stories about a lot of gold coming into this country from overseas. Here's a theory for you. And it's not mine. I didn't come up with it myself, but I've used my 34 years of experience in this business to analyze it. And I kind of believe it might have some credence. What if the Treasury's 261 million ounces of gold that they say they have isn't really there? And you have a new sheriff in town who's prone to doing a lot of audits of things like the Fed, maybe even the audit of the Treasury. What if they're scrambling? What if they, being the United States government now, is scrambling to buy gold to replace what they've already loaned out or hypothecated or never had, those 261 million ounces of gold? That makes some sense to me. Because there's something else going on. It isn't a recession. It isn't a crashing dollar. It isn't a crashing economy. It isn't a crashing stock market. It isn't falling, plunging real interest rates. What is it? Why is gold where it is? You could explain some of it with inflation, but I think there's something else going on there, and I think what I've just mentioned could be a reason.
Michael Pento's recent analysis highlights a critical economic challenge facing the United States: the persistent elevation of inflation rates well above the Federal Reserve's target. For the past 4 years, inflation has stubbornly remained higher than the central bank's established 2% benchmark, creating a complex monetary policy scenario challenging economic stability. The situation is particularly concerning given its duration. This persistent deviation from target levels raises significant concerns about the potential unanchoring of longer-term inflation expectations, which could lead to even higher inflation rates. This extended period of elevated inflation poses multiple challenges for the economy and the Federal Reserve's policy approach. The central bank's traditional bias towards monetary easing faces severe constraints in an environment where prices rise above desired levels. More critically, the sustained high inflation rates are actively eroding consumer purchasing power, while simultaneously creating a challenging environment for businesses attempting to set prices and plan for future operations. Let's get back to the interview.
If you have inflation that's running, quasi-intractable, and the Fed has and here's the punchline, Donegan, the Fed has a bias to ease, which I think is hysterical. I think that's hysterical. They have a bias towards easing. They were easing. They cut rates already by 100 basis points, but they still have this easing bias. Well, why do they have an easing bias when inflation is 4 years north of their target, their average target? You get the point. I don't want to belabor it, but when you have insolvency and you have inflation, that's what the long end of the bond market is always concerned with. And that's why yields are rising. And that's why your cost of your home, which is already as a home price to income ratio is at a record high. And when you throw in maintenance and insurance and taxes, it's out of reach. And then you say, well, wait, now the mortgage rates are going higher. They're up 100 basis points since the Fed decided it was a good time to panic in September of 2024 and cut rates by 50 basis points. That's your answer. So that's where your real problem could be. Now, I'm not saying it's definitely going to happen. And I'm not saying when it's going to happen, but you have those two real risks of when you're going to have a freezing up of the money markets. And that will cause the stock market to tumble, and that will bring down the whole house of cards. But until then, you hold your bonds, your short-term bonds, and you could hold your inflation hedges, and you can make some money while you wait for what I call the grand reconciliation of asset prices to occur. And why do I say that? Because when you look at things like the Buffett indicator, which is the total market cap of equities to GDP, currently sitting well north of 200%. So when the valuation of equities, the market cap of equities is over 2 times the level of annual GDP, which is extremely rare. This is a new phenomenon, Donegan. It never happened before in history. Prior to COVID, it just was never even thought of. The normal metric here, the normal ratio is south of 1. It's over 2. Stocks have to correct dramatically. Real estate has to correct dramatically. And also bonds. And I'm talking about corporate debt. There's a huge bubble in corporate debt. That has to correct. If you think like things like private credit, something that never existed before. This is a new invention by Wall Street. Hey, the shadow banking system is saying you're a business, you can't get a loan from a bank, and you can't tap the corporate bond market. Well, come to us and we'll give you a loan. And there's $1.5 trillion of that stuff out there. Now, when we have a recession and people are going to call up their friendly financial institution and say, that money I gave you for that private credit loan, I want it back. Well, we don't know what that market is, and you can't get it back. That's a real problem.
Gold's persistent rise despite unfavorable conditions, such as rising interest rates, a stronger dollar, and geopolitical stability, points to underlying factors beyond traditional market dynamics. With inflationary pressures, monetary policy shifts, and potential concerns about the actual state of gold reserves, the continued strength in gold prices suggests more profound structural issues may be at play, keeping demand for the metal elevated. Do you think gold prices will continue to rise, or is a significant correction coming? Let us know in the comments below. If you found this video helpful, don't forget to like, share, and subscribe for more insights. Thank you for watching, and stay tuned for our next video.